Hello and welcome to the week ahead video with me, David Madden. Now before we take a look at the major events of next week, let's just take a quick recap of the major events of the week just gone. We've seen major selling pressure in stock markets around the world, especially US markets, as there's increasing chatter the Federal Reserve will look to hike interest rates in March. There's also increasing speculation that the Federal Reserve might have 4 interest rate hikes in 2022 rather than the 3 that was projected at the December Fed meeting. Now, why will the US30 be in focus next week? Well, on Wednesday we have the Federal Reserve meeting. Economists are not expecting any changes to the interest rate policy, but the commentary from the Federal Reserve will be in focus. Any language that we see from the Federal Reserve could influence government bond yields. Keep in mind we've seen the US 10-year yield and the German 10-year yield hit their highest level since 2019. The upward move in government bonds around the world, in bond yields around the world, be it the UK 10-year yield, the German 10-year yield, the US 10-year yield, this has been putting downward pressure on global stock markets. Hence why we've seen the US30 fall to its lowest level since early December. And while it continues to hold below these 3 simple moving averages, it's likely the recent bearish trend will continue. A move lower from here could see a target at 34,226, and a break below that could see a target this zone at 33,949. If you do get a rebound in the US30 from here, resistance might be encountered from this zone at 35,491, and a break beyond that could target this zone here at 36,032. Now, US indices across the board will be in focus next week because of the Federal Reserve meeting, but we also could see an increase in volatility in the US dollar. On Wednesday, not only do we have the Fed meeting, we also have an update from the Bank of Canada. Economists are not expecting any interest rate changes from the Bank of Canada, but once again, the language that Canadian central bankers use is going to be very much in focus. USDCAD has been in a downward trend in recent weeks, partially due to the retracement seen in the US dollar. The US dollar hit its highest level in well over a year in mid-December, but since then it's been broadly moving lower. Lately we've seen a strong oil market. Oil has hit its highest level in 7 years. That's pushed up the Canadian dollar and in turn put downward pressure on USDCAD. Even though we have seen a bit of a rebound in the currency pair, dollar CAD continues to hold below these 2 simple moving averages, and while it continues to hold below these 2 simple moving averages, it's likely the more medium term bearish trend will continue. A move lower from here could see a target this region of 1.2386, and a break below that could see a target this area at 1.2299. If you do look to have a rebound from here, because if you can see on the RSI, it's moving higher, we can see there's a steady increase in positive momentum on the MACD indicator, so it suggests that in the near term, the bulls are now in control. If you do see a move higher from here, resistance might be encountered at 1.2569, and a break beyond that could target this region here at 1.2696. Also, in relation to US dollar crosses, the AUD USD will be in focus next week too, as on Tuesday Australia will post its latest CPI numbers. AUD has been in an upward channel in recent weeks. And even though in the very near term AUD USD has been moving lower and is below these 3 simple moving averages, it's worth noting that while it continues to hold above this trendline support area here, it's likely the more medium term upward trend will continue. If you do look to rally from here in AUD USD, it might look to retest the highs of January in at 0.7313. On the downside, if it do manage to break below this trend line here, AUD USD might look to retest the recent lows of 0.7169, and a break below that could see a target the lows of early January in at 0.7129. That's all from me for this video. Thank you very much.